In this video, let's talk about the accounting for merchandise entities. First question, do these entities follow the same accounting process of service entities? The answer is yes, of course. But do accounting for service entities and merchandise entities differ? Again, of course, but they only differ a little bit, and it is because the merchandise entities do the following. So we have accounting for sale of goods. So the merchandise entities sell tangible goods unlike the service entities. That is why we have here the accounting for the selling of goods. And of course, we have number 2, accounting for purchase of goods. Of course, those goods that you're going to sell must be purchased, right? So there is also an accounting for purchase related transactions. And at the end of the year, unsold goods must be counted. So there is also what we call the inventory count. Again, these 3 are not done by service entities. So we will go through them one by one. But before that, I would like to introduce myself for those who are new to my channel. I am Gletsmar B. Kasama CPA, your accounting teacher for today. I have already mentioned that we are going to go deeper on these 3. But before we do that, I would like to emphasize that because of these 3 again, the income statement for service entities versus the merchandise entities differ. So let's have the first one, which is the income statement for service entities. So as you can see, it is as simple as revenue less expenses, and then you are going to get the net income immediately. As for merchandise entities, it's a little bit complicated. For example, instead of service revenues, we are going to have the net sales. We still have expenses though, but they're already subdivided into 2. The first is the cost of sales, which is very literal. This is the cost of goods sold without the markup yet. And the second one is the operating expenses, which is further subdivided into general and administrative expenses as well as the selling expenses. The selling expenses are those costs which are incurred in the effort of selling goods, examples of which are commission expenses for sales agents or consignees. Another one is advertising expenses or rent for the store space and other expenses related to selling the merchandise. We also have general and administrative expenses like salaries of the executives in the company and other expenses which are not directly related to selling or not directly related to the purchase of goods to sell. Now, after deducting the cost of sales and these expenses from the net sales, then you are going to get the net income. And by the way, as an additional information, I would like to tell you that the net sales, when you deduct the cost of sales, the difference is called the gross profit. But there's more. The cost of sales can be computed using this. So we have the merchandise inventory beginning or the unsold goods in the last period. So you add the net purchases for the current year and you will get the total goods available for sale, which is very literal in meaning. Again, the unsold in the past, which is the merchandise inventory beginning, plus the goods purchased currently is literally the goods that you will be able to sell in the current year or the total goods available for sale. So deduct from this the unsold for the current year or the merchandise inventory end, and you will get the cost of sales or the cost of goods sold during the year. And that's it for the income statement of service entities versus the merchandise entities. Now, let's go back to these 3 and let's start with the accounting of sales related transactions. So we are now in the accounting for sales related transactions. But before we move to that, let me put here the cost of sales computation as well as the income statement for merchandise entities because we will refer to this all throughout this video. So what is the journal entry when selling goods? So let's have an illustrative example. For example, we are ABC and we sold goods on account worth 200,000. The entry here is as simple as debit, accounts receivable 200,000 and then credit sales of 200,000. But if the customers pay cash immediately, then the debit is cash instead of accounts receivable and then credit sales again. However, you need to know when will you make this entry? So the answer is, you make this entry when the ownership of the goods are transferred already to the buyer. To be specific, we have here the rules on the transfer of ownership. Number 1 is, if the goods are already in the property of the buyer, for example, you sold goods to X company and those goods already arrived in their company's premises, then you can already record debit AR or cash and then credit sales. I would like to emphasize though that the buyer's property also include its trucks or airplane if they have one. What I mean is, for example, if the goods you have sold are picked up by the buyer's trucks, then even if the goods did not yet arrive at the buyer's premises, the title of ownership has already been passed to the buyer. And if that happens, then as a seller, you can already debit accounts receivable or cash and then credit sales. There is another thing to remember though, and that is if the goods were transferred on consignment to another party. So even if such goods are already on the premises or property of the consignee, you still can't record debit accounts receivable or cash and then credit sales, because consignment means you only physically transferred your goods to someone or someplace, but the title to those goods are still yours. So when are you going to recognize sales? Of course, when the consignee sells them to the third parties. Another thing is, please remember that the consignees are just like custodians for your goods, and that they will ask for commission if your goods are sold. Those payments are considered as selling expenses of the seller. So that's it for the first rule. The second rule is that if your goods are still on your premises as a seller, even if they are already prepared or packaged already and it's in the for delivery area already or for shipment area, you are still not allowed to recognize it as sales. There is an exception though. For example, you pack goods for a customer and it is ready for pickup by the customer already. You and the customer agreed that the customer are to pick up the goods from your company. In addition, it has been emphasized that goods are uniquely customized for the customer, which means that the goods cannot be sold to another customer. If that is the case, then even if the goods are still in your property or specifically in your delivery area, you can already record it as sales. So that's it for the second rule. Let's go to the third rule. So this rule is for those items that are in transit. What is the meaning of that? It means that you sold goods to a customer already, but those goods are still on the courier or still in some logistics company, which means it's not already in your premises, but it's not yet also on the buyer's property or premises yet. The question is, who is the owner of those goods? So if the goods are still in transit, please check the shipping terms, because it depends upon the shipping terms. So if the shipping terms is FOB Shipping Point, then it means the title of the goods are already transferred to the buyer, because FOB Shipping Point can be translated in simple terms as the title passes upon shipment. So if the goods are in transit under FOB Shipping Point, you can already recognize those goods as sold or sales, because again, it's already the buyer's. But if the term is FOB Destination, then the goods in transit are still owned by the seller, because the shipping term means the title of the goods is only transferred upon arrival of the goods at the destination. And if you are the seller, you cannot consider those goods as sold yet. So that's it for the transfer of ownership of goods. But is it really important, sir? Let's find out by considering this illustrative problem. ABC sold goods on first 12/31/20x1 and the second one is on 12/27/20x1 under the terms FOB Destination, and another set was sold under FOB Shipping Point, which is on 12/29/20x1. So which are considered valid sales to be recorded in 20x1 if the delivery time of ABC to customers is 3 days. So let's start with the sales on 12/31/20x1. As you can see, the goods here are already shipped at the last day of 20x1. So it means the goods will arrive to the customer's premises in the next year already because of the 3-day delivery period. It means that in the current year, which is 20x1, the goods are still in transit. So you need to find the shipping terms. And in here, it is said that it is on FOB destination. So it means to say, you can't record it as sales for 20x1 because it's clearly a sale on 20x2. We also have the second sale which happened on 12/27/20x1. So if you analyze and put in the equation the 3-day delivery period again, we can say that those goods arrived already on the buyer's premises in 20x1. So it is already a valid sales. The shipping term FOB destination is already useless since the goods are not in transit already at the end of 20x1. And the last sale dated 12/29/20x1. If you consider again the delivery time, it can be concluded that the goods are still in transit and will arrive only on 20x2. However, since the shipping term is FOB shipping point, then it is already considered a valid sale in 20x1. I hope I made that clear. So again, is it important to know the rules of transfer of ownership? Yes, of course, especially if we are talking about sales occurring near the end of the current year and the sales occurring early of the next year. Remember always that transactions of the company must be reflected in the correct year or period it occurred. So additional knowledge. If the goods are in transit and there is no mention of shipping terms, then please assume that the goods are shipped under FOB shipping point. So that's it for recording the sale. But wait, there's more, and that's up next. Aside from the recording of sales, there are also times that the customers return goods, especially if they are damaged or the goods received are actually far from the specifications of the customers mentioned on their purchase order. So we have an example right here, which is ABC received goods returned by customers because of defects. The goods were sold for 50,000 previously, but the cost is only 40,000. So this means there is a markup of 10,000. The journal entry for the transaction is simply debit sales returns and allowances of 50,000 and credit accounts receivable 50,000 if the customer is assumed that it has a purchased on account and had not yet paid. However, if ever they have already paid, instead of crediting the accounts receivable, we are to credit cash, which is actually considered a refund. So that's it for sales returns and allowances. The next that we're going to talk about is the sales discounts that might be availed by customers. But before we go to the journal entry, I'll discuss first the two types of discounts that may be availed by the buyers. So we have here the trade discount and the cash discount. So the trade discounts are given to customers to encourage them to buy more. For example, as part of your marketing efforts, you offered a buy one take one promo, or you offered that if a customer buy a large quantity of goods, he or she will enjoy 20% off. Now, what is the journal entry of the seller if the buyer availed for a trade discount? The answer is none. It is because the sales account that you have recognized here is assumed to be net of trade discount already. As a matter of fact, the sales invoice that you are going to issue to the buyer is already net of trade discounts, if any. Let's go to cash discounts. Cash discounts are given to customers in order to encourage them to pay early. So we have an example right here. You have given your customers credit terms of 3, 10, and 30 for goods sold on account worth 100,000. So what does it mean? It means you are to give 3% discount to customers if they can pay within 10 days and no discount at all if the customers pay after 10 days to 30 days. So that's the meaning of that. So what are the entries if the customer paid within 10 days? So let's first start in the date of sale. The entry is simply debit accounts receivable 100,000 and credit sales 100,000. But on the date of the collection within the discount period, you are to debit cash 97,000. So it's already net of the discount. But you are still to credit accounts receivable of 100,000. The other 3,000, the balancing figure, is what do we call as the sales discount of 3,000. Now, what if the customer did not pay within 10 days? The entry is as simple as debit cash 100,000 and credit AR 100,000. Now, in order to master what we have learned here in the discounts, let's have another illustrative problem. So we have here on 3120x1, you have given your customers trade discounts of 5 and 7%. The credit terms extended is 3, 10, and 30 for the goods sold on account worth 100,000. The meaning of this is that you have given 2 trade discounts and a further discount of 3% if the buyer pays within 10 days. So what will be the entries related to this assumption number 1? If the buyer paid on 3/5/20x1, or in simple terms, within the discount period. Of course, we'll start with March 1, the date of sale. The entry is just debit AR, credit sales. We know that these amounts that we are going to put right here should be net of trade discounts. But how do we compute it? So the list price is 100,000, right? So if we apply the first discount of 5%, then we are going to get 95,000 as the net amount. And then we deduct the second trade discount of 7%. The 7% will be based on the 95,000, not on the 100,000 list price. So the amount here will be the 95,000 minus the 7%. So if you wanted to be fast, you have 95,000 times 0.93, which will equal to 88,350. At the date of the collection within the discount period, the AR will be credited at 88,350, but the cash will be debited only at 85,699.5, which is already net of 3%. The 3% was computed based on the 88,350. Not on the 100,000 and not on the 95,000. The balancing figure in the debit is the sales discount of 2,650.5. So to complete this, let's have the assumption that the buyer did not pay within the discount period. So it's on 3/15/20x1. So we have our entries right here. So these particular entries are similar to this set of entries, except that we did not record any sales discount and that the cash we have received upon collection is the full 88,350. So that's it. But before we move forward, I would like to emphasize the 3 new account titles with green colored fonts that I have introduced a while ago. So we have sales with a normal balance of credit, we have sales returns and allowances, and the sales discount with a normal balance of debits. So these 3 composes this net sales. So again, net sales is gross sales less the sales returns and allowances and sales discounts. The sales returns and allowances and the sales discounts are considered as contra sales or contra revenue accounts. So that's it for this slide. Now, let's go to another sales related account, which is the freight out or transportation out. So we are now on the topic transportation out or freight out. So what is this? This is the cost for transporting goods to customers. So is there an entry related to this? Yes, of course. But the problem is the journal entry is not fixed. The entry actually depends on who is responsible to pay for the freight. Is it the buyer or the seller? And aside from that, you also need to know who actually paid for the freight. So let's start first with who is responsible for the freight. Answer: of course, the owner of the goods while it's in transit. It means to say that it is actually related to the shipping terms that we have discussed earlier. So we have the shipping terms FOB destination and FOB shipping point. If the shipping terms is FOB destination, we have learned that the owner of the goods in transit is still the seller. But let's add something to that. Aside from the ownership, the seller is also burdened with the responsibility for freight. Again, if FOB destination, who is the owner and who should be responsible for the freight? The answer is the seller. And of course, in the opposite, if the shipping terms is FOB shipping point, the owner of the goods in transit and the ones responsible for the freight is already the buyer. Next is we need to answer who actually paid for the freight. So we have two instances or two freight terms that you need to understand. The one is freight prepaid, or in simple terms, before the goods are delivered, the freight or the transportation fee has already been paid by the seller. And we have the number 2, which is the freight collect, which simply means that the buyer actually paid for the freight or transportation fee when the goods are finally received by the buyer. Now, let's move on to the application of what we have learned. So we have a situation right here. So we have our example. 3,000 was paid for transportation of goods to customers. So what are the entries? Of course, it depends. The entries depend on these 4 possible combinations that we need to understand. The first one is FOB destination freight prepaid, which simply means the ones responsible for the freight is you as the seller, right? And since it's freight prepaid, it also means that you as the seller is also the ones who actually paid for the freight. So the entry for this is just debit freight out 3,000 and credit cash 3,000. The second possible combination of shipping terms is FOB destination freight collect, which means that the responsible for the freight is the seller, but the ones who actually paid for the freight is the buyer. So as a seller, your entry will be debit freight out and credit the accounts receivable. Now, the accounts receivable from the customer is decreased here because again, your responsibility was actually satisfied by your customer. I hope it is clear. The third combination is FOB shipping point freight prepaid, which means that the buyer is responsible for the freight, but you as the seller paid for it. So in the entry, since you are not responsible, you can't debit the account freight out. Instead, you need to debit the accounts receivable of 3,000 and then credit cash 3,000 because you assume the responsibility of the buyer, so you are going to collect it in the future. Now we have the fourth combination, which is FOB shipping point freight collect, which means that the customer is responsible for the freight and the customer is also the one who actually paid for the freight. So meaning as a seller, this is not a transaction concerning you, so you will have no entry. So that's it. But before we end this video, I would like to tell you that freight out account is not part of the net sales, but is actually part of operating expenses, specifically in the selling expenses. So that's the end for this video lecture. I hope you learned. In the next video, we will be talking about the purchases related transactions.